Silver investors, they spent 3 months defending $80 like it was a national border. Yesterday, that line didn't just break, it detonated on the back of the largest U.S. military buildup in the Middle East since 2003 and a brand new war premium that just rewired every silver model on Wall Street. I'm OG John AG, and in this video, we're going to talk only about silver, how this $133 institutional target just went from 3 to 5 year scenario to 6 12-month destination, why the war premium has flipped the options curve, crude, and COMEX into the same direction, and what it actually means for you when 80 is gone, 90 is in play, and the Strait of Hormuz is suddenly the most important price level on your entire screen. This is financial warfare education, not financial advice. I don't sell signals, courses, certainty, or silver. Anyone using my name to do any of that is a criminal. Verify everything. Your decisions, your responsibility. Let's go. Segment 1, the $82 detonation, 3 months of border defense obliterated. Let's start with what actually happened yesterday, because most of you are still processing the emotional shrapnel. Silver opened around $87.50 in early New York trading, tested $88.20 briefly on residual momentum from Friday's close, then got absolutely eviscerated. By 2 p.m. ET, $84 was gone. By 3 p.m., $83 vaporized. Final bell, 82.17 bid. A 6.33 point intraday range on volume that clocked in at roughly 2.8x the 20-day average. You know the feeling, that pit in your stomach when you refresh TradingView for the 47th time in 90 minutes. The group chat blowing up with "I told you so" screenshots from the perma bears who called $70 in January. The cousin who laughed at your silver stack 6 months ago now texting, "Told you bro, sell it all." The voice in your head calculating unrealized losses from the $93 open last Friday, wondering if this is the beginning of the end. That's exactly how they want you to feel. Wall Street's $82 masterpiece wasn't random volatility. It was a precision-engineered capitulation event. 3 months of retail investors, small funds, and even some mid-tier institutions defending $80 like it was the Maginot Line. And yesterday, the market didn't break through. It went under, around, and over it with overwhelming force. But here's the part you're not supposed to notice, the context. While you were staring at your red P&L, 3 structural catalysts converged to make $82 not a breakdown, but a detonation of weak hands. First, the U.S. military announced the largest Middle East deployment since the 2003 Iraq invasion. Carrier strike groups, B-52 wings, Patriot batteries, logistics tail the size of a small country. Second, crude oil futures spiked 4.2% overnight on blockade fears through the Strait of Hormuz, dragging every inflation-sensitive asset into repricing mode. Third, the silver options curve flipped bullish for the first time in 90 days. Implied volatility exploded 27%. Call buying overwhelmed puts 3.1 by notional value. Those aren't coincidences. They're the hidden wiring behind yesterday's bloodbath. And when institutions see that wiring light up while retail panic sells into a volume climax, they don't see catastrophe. They see a loading zone, a fire sale, the mathematical bottom where amateurs hand over contracts to professionals who understand what comes next. Scroll back to your chart. That massive volume bar on March 3rd, that's not bear strength. That's exhaustion, capitulation, the final terrified sellers dumping into hands that were waiting. Let's unpack why. Segment 2, exhaustion, candle anatomy, the 3 mathematical proofs you can't ignore. Exhaustion candles aren't fairy tales from some 1980s trading book. They're repeatable, measurable patterns that institutions have weaponized for decades. Yesterday's $82 close checked every box. Let's break down the anatomy so you can spot the next one and stop being its victim. Proof number 1, volume climax, 2.8x average. Normal silver trading days see 45,000, 65,000 contracts change hands. Yesterday, 182,000 plus. That's not high volume. That's a selling climax. When volume spikes 2 to 5x average on a down day with wide range, it means one thing: every available weak hand hit the eject button simultaneously. Stop losses triggered, margin calls executed, leveraged tourists who bought the $93 Friday open puked out at any price, funds with strict risk mandates cut exposure, algos hunting retail stops joined the party. The math is brutal. Once that cohort is gone, selling pressure drops to 0. No one left to dump. Bears exhausted. Volume bar, capitulation footprint. Proof, BER2, intraday range explosion, 633 points. Silver's average true range over the last 60 days, 3.8 points. Yesterday, 633, 66% wider. That's not orderly price discovery, that's panic. Opens at $87.50, fakes $88.20, stop hunt, plunges to $82.17. Classic algo behavior: trigger every obvious level, shake out maximum liquidity, then decelerate into close as sellers dry up. Check the 15-minute chart from 1 p.m. 4 p.m. ET. Heavy red volume 1 to 2 p.m., fading volume 2 to 3 p.m., barely trickling by 3:45 p.m. Momentum died because sellers ran out. That's exhaustion, not acceleration. Proof number 3, close location, lower 20% of range, 82.17 close in a 82.17 $88.50 range, you bottom 18% of the day's action. Bears won the day but closed weak. No conviction follow through. If $82 was a real breakdown, close would hug lows with building volume into bell. Instead, climax, exhaustion, stall, all 3 proofs aligned, you're staring at a 78% historical probability of V recovery within 72 hours. Institutions live for these setups. You should too. Drop a comment right now. Did yesterday's volume bar make you panic sell? Or did you recognize the exhaustion print? Be honest. Your answer determines whether you survive the next one. Segment 3, Wall Street's $82 masterstroke, engineering capitulation for institutional loading. Wall Street didn't lose control at $82. They designed it. Banks don't smash silver to $82 because they see $70. They do it because they need massive long exposure at the best possible price, and they can't buy openly at $93 without spiking to $100 mid-fill. Here's the playbook they've run for 50 plus years. Phase 1, pre-climax shorting, Feb 15 to 28. Sell short aggressively while retail defends 80, 85. Push narratives through proxies. Geopolitics priced in. Dollar strength. Industrial demand slowing. Create doubt. Phase 2, capitulation trigger, March 3rd. Time the breakdown for maximum psychological impact. Hit every obvious stop cluster, 84, 82, 50, 81. Algos amplify. Retail sells to retail in blind panic. Volume explodes. Phase 3, exhaustion confirmation, deceleration into close. Selling dries up. Weak hands purged. Phase 4, cover plus. Accumulate shorts, cover for profit. Institutions buy the panic at discount. Same session. Your red candle burst their loading zone. Yesterday's 182K contract volume? Smoking gun. That's not organic selling, that's engineered capitulation. Wall Street extracted your contracts at $82 so they could own the next leg to $95, $110, $133. They're not panicking, they're celebrating. You're their discount rack. Understand, this isn't superior information, it's superior execution of human psychology. They know 93% of retail can't handle a 12% drawdown. They know your stops cluster at round numbers. They know Friday's $93 high made you anchor emotionally. They weaponize that knowledge every single time. Your countermeasure, data over emotion, volume climax, plus deceleration, plus war premium tailwinds. Buy signal, not sell signal. Segment 4, the war premium rewire, Middle East buildup changes everything. Now let's talk about the elephant that smashed your $80 border, the largest U.S. military buildup in the Middle East since 2003. This isn't posturing, this is hardware. USS Eisenhower and USS Abraham Lincoln carrier strike groups forward deployed, B-52 Stratofortress wings relocated to Diego Garcia, Patriot missile batteries doubling in UAE Saudi positions, KC-135 tanker squadrons tripled in theater, logistics tail, 18 C-17s, 42 C-130s rotating supplies 24/7. This is not a tweet storm. This is the physical manifestation of Strait of Hormuz risk, the choke point through which 21 million barrels of oil per day flow, 20% of global supply. What does a credible blockade threat do to every silver model on Wall Street? 1. Crude, inflation, real yields. Dollar oil spikes, 4 to 8% overnight fears. Energy inflation reaccelerates. Fed rate cut path compresses. Real yields fall. Dollar wobbles. Metals, bid returns. 2. COMEX stress amplifier. War premium hits right as March delivery window closes. Registered silver already down 52% since October. 88M, 42 Manders OZ. Now add military risk premium to physical bid. 3. Options curve flip silver. March $90 calls traded 18.1 versus puts yesterday. Implied vol exploded 27%. Institutions aren't hedging tail risk. They're positioning for upside explosion. 4. Institutional models rewired. Every bank model had $133 silver as 2030 scenario under baseline deficit plus industrial demand. Now, 6 to 12 month path becomes base case if Hormuz risk sustains 30 plus days. JP Morgan, Goldman, BofA, all whispering the same math to hedge fund clients. Yesterday's $82 wasn't geopolitics failing, it was geopolitics loading. The buildup creates credible threat without immediate supply disruption, perfect for shaking weak hands while institutions size up. $80 border didn't break because fundamentals changed. It broke because timing changed. War premium flips every lever bullish simultaneously. Welcome to the new tape. Segment 5, crude, plus, COMEX, plus, options. The triple convergence nobody sees coming zoom in on the three mechanisms that flipped simultaneously yesterday, creating the perfect exhaustion setup: crude oil, Hormuz risk. Brent futures plus 4.2% overnight, WTI plus 3.8%, gasoline futures plus 6.1%. Why? Strait of Hormuz carries 21 mm BPD, one missed tanker, instant 5% global supply shock. Iran's missile arsenal, plus Houthi proxy coordination, credible blockade threat. Energy inflation spikes rewind, Fed cut expectations 20 BPS, real yields compress, dollar stalls at 108, silver's inflation hedge bid awakens. COMEX delivery crunch. March 1st notice past March 2, registered silver now 42 mm Oz, down from 88 mm 3 weeks ago. Open interest still implies 87 mm Oz potential delivery demand. Shorts facing 45 mm Oz shortfall, with war premium bidding physical away from paper. Yesterday's volume climax, warriors, naked shorts covering desperately while retail provided exit liquidity. Options market, call overload. Silver 90, $95, $100 March calls traded 18.1 versus puts by notional value. Implied volatility, plus 127% to 48%. Call skew flipped bullish, largest since January spike. Institutions aren't hedging risk. They're loading upside convexity at $82 discount. When all three converge, V-gap probability skyrockets. This isn't correlation, this is convergence. Crude bids inflation. COMEX bids physical scarcity. Options bid institutional upside conviction. Retail panic sell into triple confirmation. Perfect exhaustion setup. Segment 6. Capitulation. Psychology. Why $82 feels like doom, and why that's the point. Let's get real about what yesterday did to your brain. $93 Friday open, $82 close, Mars 11.8% destruction. 3 months defending $80, now it's gone. The engineered emotional cascade. Friday euphoria, $93 open. Thesis confirmed, loading more. Monday doubt, $86 test. Pullback normal, holding. Tuesday terror, $82 close. Everything wrong, sell before $70. Wall Street knows this sequence. They've A/B tested it for decades. They know 93% of retail taps out after 12% drawdown. Stops cluster $84, $82, $80, round numbers. Social media amplifies FOMO. Panic ratio 10.1. Weekend positioning leaves Tuesday stops thin. Perfect algo hunt. Your pain is deliberate, designed to extract maximum contracts at minimum price. Once emotional sellers exhausted, volume climax, selling pressure terminates. Counter programming, check volume, 182K versus 65K average, capitulation complete, check deceleration, 1 to 2 p.m. heavy, 3 to 4 p.m. dry, sellers gone, check external bids, crude up, options bullish, COMEX tight, fundamental support intact, data emotion, always. Homework, write your max drawdown tolerance tonight. I can lose X% before I question thesis. If $80 shook you, that number's too tight. Fix it before next climax. Segment 7, post-climax reversal mechanics, the V-shaped math nobody teaches. Day after exhaustion candle. JOS, highest reversal probability in bull market. Why? Supply dynamics. Selling exhausted. Weak hands purged. Shorts covered. No sellers left. Demand dynamics. Institutions accumulated. $82 discount. Asia opens 6 hours later. Sees climax. Bids discount. Europe adds 3 hours after. NY opens to gap fill plus momentum. Historical math. Bull market climaxes. 72 OSA retrace. 78% probability. Full range retrace. 61% probability. Gap open, 52% probability. Expected path. Overnight Asia, 83.50, 84.50 bid forms. Europe tests 85, NY open, 86, 87 gap. Day high, 88, 89, not guaranteed, but highest odds set up in months. Why silver specifically? Natural state. Up, supply deficit 217 MDOZ at 2025. Industrial demand plus 17%. Monetary bid accelerating, only down via active suppression. Suppression climaxed yesterday. Segment 8, Asia's overnight edge, the 6-hour head start you're missing. U.S. close 4 p.m. ET March 3. Tokyo opens 7 p.m. ET, 6 HR gap. What Asia sees, $82 U.S. close plus volume climax. SOS discount, crude plus 4.2%, COMEX registered 42 mm Aussie, critical low. War premium intact, Chinese behavior, 18 months pattern. Physical premiums Shanghai plus 2.10 COMEX. Stackers accumulated every dip. Solar EV manufacturers hedging forward. BRIC central banks rumored buying unannounced. Expected Asia action. Thin bid 83.50, 84 initially. Volume pickup tests $84, $50. By HK Shanghai open 9 p.m., 10 p.m. ET $85 possible. You wake up to pre-gapped chart. U.S. panic sellers sidelined. Global 24/7 market owns narrative. Pro tip, set alerts $84, $85 overnight. Check CME Globex pre-market. Asia prints truth while you sleep. Segment 9, historical exhaustion. Proof, patterns that don't lie, not theory. Data, silver bull market exhaustion examples. OKI 15 2025, $79, $71 climax, vol 3.x. Next day 76 gap. 3 sessions $82, plus 15%. Upper 9 2025, 63 50.7 vol 4.2x. Week 69 plus 21%. Sep 22 2024, 36.32's climax. Launched 44.60 parabolic plus 187% 90 days. Jan 29 2026, 121.106 vol 2.9x. 5 days 118 plus 11% pattern. Climax 72 RV retrace 78% cases. Full recovery 61%. Gap open 52%. Yesterday identical setup plus war premium tailwind. Probability elevated. Segment 10. The 133-hour institutional path. War premium rewrites timeline pre-March 3 models. $133 silver 2030 2032 base case. 3-5 YR horizon. Post Hormuz buildup. 6 to 12 months becomes base case. Why? Mathematical convergence. Supply 2025 deficit 217 Nazi. COMEX registered 42 amped critical. Mexico instability number 1 producer. Industrial solar plus 17% YOY. EV silver KG doubled. Grid upgrades accelerating. Monetary. Central banks bought 1,170 tons gold 2025. Dollar reserves 32 wire low. BRICS alternatives scaling. War premium. Hormuz risk. Plug 15, 25% metals premium, 1991 Gulf War precedent, institutional roadmap. $90, near-term resistance, weekly high. 95, 100, measured move target, 110, $115, COMEX breaking point, 125, 133, physical repricing complete. Your job, survive capitulation. Position through volatility, let asymmetry compound. Segment 11, tomorrow's precision. Watch list, 5 data points that matter overnight. Asia volume 84 plus, confirmation. Globex pre-market gap 86 plus. V-start, Wednesday, NY 3, 86 to 30, reclaim. Plus hold, structure intact. 4, early volume surge 87 plus, institutional follow. 5, $88, $89 test, measured move. Red flags, $81 break, volume fade, crude reversal. Physical holders, no action needed, market returns to you. Segment 12, risk reality, no guarantees, just probabilities. Highest odds certainty, bears can extend. Flush scenario, $78, $80 retest. Add core, physical only. Paper traders, stops below 80 wars. Size discipline absolute. Thesis intact, war premium, COMEX crunch, industrial deficit, monetary shift. $82 was discount, not destination. You've been watching John AG here, and I'm OG John AG. If this 5,500 word exhaustion masterclass reframes $82 from end of world to loading zone, smash like, subscribe all notifications, comment, held through 82, or learned pattern. We don't panic sell bottoms. We study tape, respect math, win time.